I'm going to explain on how to answer question October 2019 test question 1C. Okay, it is on ACE Engineering Berhad. So we have the question here. ACE Engineering Berhad is a growing engineering company situated in Alor Gajah, Melaka. The company ends its accounting period on 30th September each year. Okay, now just like jump to the requirements. So you will see there are 5 requirements for this question. First, the question require you to prepare journal entry for the land. Okay, let me pick the March. Okay, and then you have building A, impairment loss, and then you need to do factory B, the journal entries, and you need to answer on the accounting treatment, and you have to prepare the notes to the account for land, factory building B, and office building. Okay, so only 1, 2, 3, only 3. So based on the requirement, we can see that the current year is 30th September 2019, as you can see here. So now the financial year end on 30th September this year lah. Okay, 30th September 19. Okay, so of course the opening would be 1st October 18. So this is our current year. So let's go through the question. Okay, among the assets owned by the company are land, machinery, office building, and 2 factory buildings. So you can see you have factory A and factory B. Okay, these assets were bought on 1st October 2009, except the machinery was bought on 1st April 13. So only machinery was bought on 1st April 13. The rest was bought on 1st October 09. Okay. Alright, how do you depreciate the asset? So of course land is not depreciated. Factory A and factory B is using a straight line method. The useful life is 50 years. Okay, and with no residual value and monthly basis. For machinery is using the reducing balance method. 8 years useful life and yearly basis. So there's a different method of depreciation for the factory and the machine. So now the first requirement is on the land. So let me concentrate on the land first. So we have land here. Okay, the initial cost is 8 million and acquired in 1st October 2009. So the fair value of the land. Okay, this number 1 is on land. Let me go through first the additional info. Yeah. Number 2 is on the factory building A. 3 is focusing on factory building B. Number 4 is on the office building. Number 5 is on machinery. Number 6 is the general info, where it says that the company adopt revaluation model for its PPE. So when there is a revaluation model, that means you have to identify the surplus or the deficit. Okay, and then important information here, the company choose to transfer some of the surplus to retain profit. Okay, and when the PPE is used by the company. So this is a matter of choice. When the company revalue asset and when the company get a surplus, there will be an ARR. So this surplus, the company decide to transfer to return profit. If you get a question, but if the question does not mention about this transfer, so you don't have to transfer to retained earning, only when the question says that. Okay, so let's concentrate on first requirement, which is on land. You need to prepare the journal entry on 30th September 2019. Okay, now let's draw the timeline. It is very important for you to draw a timeline so that you can see the movement. So this is land. Okay, this is land. So it was acquired on 1st October 09, and the initial cost given here is 8 million. Okay, and then dia kata the fair value of the land on 30th September 14, because the company closed its year financial period is ending on 30th September. So on 30th September 14 and also on 30th September 19. This is for this year lah. Okay, this is the fair value when the company revalue on 30th September 14 is 7.1 million. And on 2019, the fair value is 8.2 million. Okay, so why do we need to look back even though we are in 2019? Because now what you learn in FAR320 is that there is the treatment for the revaluation will be different as compared to the first time revaluation. This is the first time revaluation. Okay, this is the first time revaluation, and this is the subsequent revaluation. So the treatment could be different, yeah, because you need to write off the surplus or the deficit. So this is the new thing that you will learn in FAR320. Okay, in FAR210 you only learn the first time revaluation. So here you see that land is not depreciated, so you just carry the initial cost. So the carrying value here is 8 million. You compare the fair value and the carrying value. So since fair value is smaller, you get a deficit. So the deficit is how much? It is 900,000. Okay, 900,000. Alright. Again, you don't depreciate your land. So you just carry this fair value. This fair value become the carrying value in 2014. So 7.1 million is compared with fair value of 8.2 million. So since fair value is small, you get surplus. So the surplus is 1.1 million. Okay. What you learned before is that when there is a deficit, you will debit SOPL, and of course it reduce your land, the PPE, the land, okay, by 900,000. Okay, this is what happened previously in 2014. We are in September 19. Okay, the opening would be 1st October. Okay. 1st October 19. 1st October 18. This is the opening year for the current year. Okay. So now the treatment for surplus in this year, okay, you have to use the SOPL that you created before. So this surplus, you will write off from you will use up the previous SOPL due to the deficit that you get previously. So you need to write off from you need to use up the SOPL. Previously, what you learned in FAR210 is that surplus should be credit ARR. That's correct for first revaluation, but this is a second revaluation. Okay, so for the second revaluation, okay, let me move this one first. Okay, so surplus. Surplus means you will, of course, debit your asset. So you will debit your PPE land. Alright, so that will be 1100. Okay, this figure 1.1 million. But because you get surplus, normally what you learn is you need to credit ARR. Credit ARR kan? Sebelum ni you belajar. But because this is a subsequent revaluation, you will use up the SOPL here. Up to the amount that is enough. Alright, so you credit SOPL. You only have, previously you only write off 900,000. So we will credit 900,000. Okay, 900,000 here. So there is a remaining of 200,000. Where did I get this 200,000? 1.1 million minus 900. So you get a balance of 200. Then only this one will be credited to the ARR. Okay, get that? So what you did before, deficit is debit SOPL, surplus you credit ARR. Okay, that happened for first time revaluation. For the subsequent revaluation, just like this question, you get a surplus of 1.1. You debit your asset, yes, because surplus will increase the value of the asset, but you will credit, okay, you will credit SOPL because previously you have write off into SOPL and the amount is up to the amount previously lah. So 900,000, you use up the SOPL, the balance 200,000, then you credit to AR. Okay, what happened if previously is surplus? That means previously surplus, this one should be credit ARR kan? Debit asset, debit PPE, credit ARR. In that case, for the subsequent revaluation, you just credit ARR. Okay, you just use credit ARR lah, meaning that you top up your ARR account. Okay, let me tell you, if let's say the first time revaluation. Okay, so the first time revaluation, okay, and then the second time revaluation. Okay, the first time you get deficit. The second time you get surplus. Okay, so deficit, you reduce your PPE, you credit PPE. And you will debit SOPL. That's correct. First time revaluation for surplus, surplus increase your asset, so you will debit PPE. Okay, in whatever amount lah. And you will credit ARR. This is correct for the first time revaluation. What happened for the second time revaluation? If you get surplus, you have to look back. Okay, previously I have write off into SOPL. So for this time, okay, of course, surplus will increase your asset, you debit PPE. So do you credit ARR or do you credit SOPL? So if let's say the surplus amount here is lesser than previously that you write off into SOPL, then you will use up the SOPL. So you credit SOPL and you will credit the ARR. If let's say the surplus is, okay, let's say this one is, I just take a small number, yeah. Let's say the SOPL here is 500. Previously deficit is 500 and this time it is 700. Okay, 700. That means you only use up to the amount that you have in the SOPL 500 lah. The balance is top up. What happens if your surplus is only 200? Smaller. Okay, so what you do is you will credit your SOPL to only how much you need. 200 saja kan? The ARR, the surplus di sini 200 saja. So you only use, out of 500, you only use 200. So meaning that there is a balance of 300. So you have to remember the balance that 300, it could be used for the third time revaluation. Okay? And then, if let's say this is 500 and the surplus here is also 500, that means you will, okay, let me put a different color. Okay, let's say this one is 500, meaning you use up all. So that means here kat sini 500 sajalah, tidak ada ARR lah. So guna SOPL saja 500. Okay, what happened if previously is surplus and now you get deficit for the second revaluation? So deficit, it reduce your asset, so you credit your PPE. Debit apa? So you will use up the surplus here. The ARR here, you will debit your ARR. So the concept for the figure is same. Okay, whatever amount, up to the amount that is available here. If it is not enough, then baru you debit SOPL. If the ARR here is not enough to cover the deficit here, then baru you guna SOPL untuk top up. Okay, I hope that one clear to explain. We call this as the reverse of a previous. This is a reverse. Okay, ataupun we use up the previous surplus or deficit. Okay, that will actually answer. This is the only answer for requirement 1. Alright, debit PPE, credit SOPL, and credit ARR. Okay, we stop here.